Hey folks, tonight you'll bear with me. My voice has been raspy for about 2 days now, but we want to have a conversation with Abraham Ongenge, Head of Personal and Private Banking at Stanbic Bank, focusing on the retail landscape in Kenya, in East Africa, and across the continent. Abraham, as always, karibu sana.
Thank you. Thank you very much.
Thank you for joining us. So Abraham, this market is undergoing a significant overhaul in the risk-based pricing regime.
Yeah.
From CBR, from bank-based models to Kesonia.
Yes.
Interestingly, we are seeing a number of banks leaning back towards CBR when the clamor was for interbank. What's at play here? What's happening at Stanbic?
I think at Stanbic, we've kind of done a deep dive of our customers, and our approach is actually to offer a blend of both CBR and Kesonia, understanding very well that different customers will have different preferences. Some of them would want a rate that ties back to activities around cost of funding in the market, and some of them would want certainty, and therefore CBR becomes a much more preferred rate to use. So at Stanbic, we've offered both. There are customers who are choosing to go through Kesonia. There are customers who then choose CBR as their rate. The important thing here is that all these rates are transparent to the customer and therefore comparable in the market. Would
you say there's a bit of a complexity issue at play here?
Yeah, there's a bit of a complexity issue at play. Kesonia's intention was almost to marry the macro effects considered when getting the CBR rate and to kind of look at the actual interbank activity and the cost of money at the moment. So kind of creating a better lag around what that blended rate would look like. CBR, a little bit more forward-looking and looking at macros, and therefore provides one single rate that can be relied on and a little bit stable, because then it remains in force until the next MPC decision.
Given the sort of experience we've now had with the transition to Kesonia, would you say we are pushing the envelope as far as transmission goes?
Yeah, I think the good thing is that it creates transparency for the customer. Yeah. So the one big gain is that all a customer needs to ask the bank is, what is your K? Because CBR and Kesonia, what is my risk premium? Yeah. And therefore you walk to any institution, the pricing is now much more transparent. I do think the transmission will balance out, because at the end of the day, the CBR is an MPC considered decision. So we do apply the mind around where it should be at. And then Kesonia also balances with what are people willing to lend money to lend money at. So I think it's a balanced view. We have to appreciate there will be teething problems here and there, but then there is intention and collaboration to ensure that we have a smooth transition. We at Stanbic have already made all the implementation and communicated to our customers as such.
And we've seen the industry NPL ticking downwards from the latest update we got from the Central Bank of Kenya. Do you feel the credit risk environment has significantly improved, or how do you assess it?
There's definitely pockets of increased liquidity in the market, and therefore a lot of customers who were in distress are coming back to banks to say, can we have a better repayment plan? It is also quite advantageous in a low interest, then the repayment plan is affordable. Most customers then also choosing to restructure at this moment. So there's pockets of that. The risk we still see is that while one other alternative to resolve NPLs is to dispose assets and receive cash flow, there's still almost some element of glut. So most auctions as a way to dispose, whether through private treaty or through forced sales, are not returning results. So there's still some element of slowness in the resolution, but definitely the increased liquidity in the market has helped in us kind of replanning with our customers and relooking at ways to resolve the distress.
And from a risk appetite now on your side, are you getting a lot more comfortable with what you're seeing in the market to be able to gauge on more risk? Or are you still, especially given all the talk about we're heading to an election cycle, are you feeling that we need to be abundantly cautious even as we look forward?
The best way to approach any risk taking is to provide solutions within the context of the operating environment. There are pockets where there is immense opportunity to grow.
Yeah.
There are pockets where you will kind of take balanced risk as you watch the dynamics of the market. I have to say, pockets such as if you can offer better housing solutions for your customers,
yeah,
that's a pocket we will grow at, because then we have certainty in the funding, then we can go forward and support our customers to own homes. There are areas where, especially areas that have suffered trade cycles, those are areas where you need to understand the customer's cash flow cycle much better and provide an appropriate solution, because it's an area where risks can come back.
It looks like you're doubling down on your mortgage book here.
Yes, we actually do believe that we have an opportunity to provide homes for our clients, and definitely to give clients the opportunity to own their first homes.
Yeah.
So we see that as a good space, partly also because it's an opportunity for us to support the government agenda. It's an opportunity for us to source much smarter in terms of funding from a long-term perspective and support our customers to own homes. It's a way in which we contribute to modernizing the lifestyles of our clients.
And what sort of innovations should we expect to see you drive in personal and private banking on the Stanbic Bank side for 2026?
We actually believe that innovation now has become contextual, and it's probably becoming a bit more invisible. So the client wants innovation, but he wants that innovation to be invisible for the client. So if you think about in the old days, checks were innovated, and we actually used to be trained on how to write checks, how to write deposit slips. When you go to a bank, you are told, this is how you behave in a bank. That was visible innovation. Now we are moving to invisible innovation, where experience is what matters. So at Stanbic, we actually look at it to say, how can our technology be always on, always secure, and offer faster, more reliable experience for our customers? One specific one is to say, how do you make sure that you anticipate the needs of your customer through their life journeys? Yeah. So we have been quite dominant on the private bank side, yes, but we've also realized there's an opportunity for us to partner on the life moments of the young professionals who are growing. Someone who wants to own their first car, their first home. But how do we do that? We want to now start anticipating that what are the risks that they are facing. So we are innovating around, can your bank account also be an opportunity for you to have insurance in case you've lost your job? Yeah. So we are innovating around an account that has embedded insurance in it. Can we provide pre-qualified limits that are available digitally for clients in case you go and find your first car and a good deal and you just want to pay for it now? Yes. Can we actually make sure that you can make that decision now and move on? Then can we also help you in terms of understanding that if you are a young professional, you haven't earned collateral. So how do we innovate around unsecured lending? Yes. Understanding cash flows, which are very different. I mean, some of these clients are on the gig economy.
They're too cyclical.
They're too cyclical. Yeah. How do we understand that pattern? Use technology to then say, this cyclicality also provides some level of certainty in a way. Yeah. These are limits we can provide. And then we say, if you want more, let's come and discuss. So we've made solutioning around financing simple.
Yes.
We've made protection of cash flows for our clients simple. We've combined it even for business owners and then said, how do we then also support your business as much as when we are supporting you as a person?
But Abraham, as you do that and push the innovation downstream, the question becomes, how do you de-risk that? For example, I'd imagine you are considering a number of guarantees for the kind of products you have now for those in the gig economy, because there is no certainty around their cash flows.
Yeah, so a lot of this is to appreciate that customers have various income sources. Kenyans are known to always have side hustles. Part of it is leveraging on the Kenyan psyche of side hustles to say, do we understand you fully? Because when you only rely on a salary, you don't make the right decision for the customer. So part of how we de-risk is expanding the catchment, our data levels, our ability to kind of understand you as a whole. You receive some rent somewhere. You receive some money from a farm somewhere. How can we look at you holistically and then provide a solution? That gives us some level of mitigation because we're understanding our customers better. Where we are getting into risks that are new, so we are betting on a certain economic sector or a group of people. We then partner with our various financiers to offer some level of guarantee. We've done that quite well in supporting women, as an example, to say they don't have collateral, but they do have good cash flows and they need support. So we then use guarantee, do some risk sharing, and support our customers. For long-term debt, we've partnered, for example, with KMRC for affordable housing, where we then blend the cost of financing, then translating that to a cheaper cost of financing for people's homes.
When you embed insurance solutions in a bank account, for instance, you are embedding a fast-moving product, which is a bank account, with a lethargic moving product, which is insurance. Our insurance penetration is about 2%. What sort of traction are you seeing in the market for that kind of a product?
That's an important problem to solve because we believe that there is a lot that insurance can do in enabling this market take more considered risk. So take risk while you have some level of protection. Now, the way you then do it is that you make it invisible. Okay. So you almost say, long gone are the times when you used to be charged a service fee just for the sake of the service fee. We actually say, let's give value. Let's give value to this. So you are invisible. The fast-moving product of you are doing transactions, you're paying, gives you in return an insurance premium contribution that we then do for you. We get it at a much better price because then we have scale. So then it's cheaper to the customer to obtain very important insurance such as retrenchment, credit life, because we can be able to negotiate at scale for many customers at lower premiums.
I see. Makes sense there. F24 was very different from F25 in terms of a yield environment. Just give us a sense of how the cost of funding looks like when you look into the year just behind us.
There are two things that are going to inform cost of funding. One is, as financial institutions, there's been improved awareness around making money work for you in this market. And therefore, a lot of our customers, both individuals and corporates, are actually quite sensitive around the yield they get for the funding they provide. It is known to this market that we've seen very good traction around money market funds, investment vehicles. Those are providing alternatives of where customers are now putting their wealth. We do have those solutions that are available, and we've democratized that journey for our customers. What that means is that there is a fight for liquidity.
Yes.
In the market. So cost of funding may almost be a balance of that. So where you need liquidity, you probably will need to pay a little bit higher for it. But if you offer seamless transactional solutions, then people put the pocket of wealth that they have for purpose of transactability with you, because they are using that money for their daily lives. The challenge here is that we are relevant into the lifestyle of our clients, yes, and offer seamless transactional capability. Therefore, we are able to protect our cost of funding.
Okay. Abraham, I know you're tight on time here, so we need to get dialing down. There's a lot happening in the global macros, and we can't close a conversation without touching on what we are seeing there. How do you see the developments transmitting into the Kenyan economy? Stanbic Bank is a huge player in the trade finance space. Are you seeing opportunity? Are you seeing risk? How do you see that?
I think the happenings in the global economy remain uncertain, but they are shaping how we think about trade going forward. Standard Bank and Stanbic always believe that we do need to grow Africa. And if you think about it, our ability to do trade across our continent protects us in a way.
It's a hedge.
It's a hedge in a way. And we are sitting at a very opportune space, being the biggest bank in Africa, to facilitate that. So we have some level of hedge by betting on Africa as Stanbic and as Standard Bank. But we also do realize that we are an ecosystem that then balances with the rest of the world. We are seeing some pressure in supply chain, as an example, with probably one of the biggest airport being closed.
Exactly, yeah.
It does affect some of the goods, equipment that probably needed to be here on time, and therefore affects trade in Kenya. The advantage, though, is that Kenya has many partners. So you can look far east, our Chinese partners, and enable that, and Stanbic has very good partnerships with banks and financial institutions there to enable trade to happen in that space, to mitigate some of these risks that we see. So I see opportunity in us doubling down trade within Africa.
Okay.
I see mitigation in our ability to then diversify the opportunities for our customers to trade across the world, but a requirement to constantly monitor, because these changes they take different shapes every day, yes, whether it's tariffs, whether it's wars. The form of it changes every day.
Final question, Abraham. What are the top 2 trends you're looking at for the banking sector in 2026, especially with the retail optic?
One big trend is AI. So that I'm kind of looking forward to that. The next big trend is privacy, data privacy. Which then they look as if they are conflicting, yeah, but I do think they can be leveraged together. So those two are probably big conversations for 2026. I think AI is going to make banking much easier, much more personalized, and much more invisible. I think privacy then creates the element of how do you then become responsible a financial institution by protecting your customer while at the same time providing personalized service. So those two trends are things to watch out for.
But just a quick follow-up there, Abraham, is that we're having AI and talking about the scaling of neobanks, and we are asking ourselves whether banks 5-10 years from today will be in the form and shape that we have like Stanbic Bank today.
Yeah, I mean, that's an elephant in the room. Our challenge for banks is that we have the advantage of the fact that we have created one big, what I would say, goodwill, and that is trust.
Yeah.
So the banks for today have that one big goodwill, which is trust. Our ability to then guide the transition into neobank with that element of trust is what we need to play on. I do think we have the capital, we have the know-how to be the ones to lead the transition into neobanks, because the element of trust is so critical in this market and world over. And we can leverage that to then be the ones to guide into the neo world.
Folks, unfortunately, we have to close it at that point. Once again, apologies for my raspy voice. It's getting better. We've been speaking to Abraham Ongenge from Stanbic on the banking landscape and especially on retail. Keep it business redefined.